Hello guys, this is going to be a continuation from lesson 11 on time frame selection and institutional order flow. Now in the previous lesson, which is part A of lesson 11, we talked about time frame selection and selecting your trading discipline based off of your lifestyle and also your temperament. Now we're going to talk about what institutional order flow is, essentially in price. Now I know classic price action, you know what an uptrend is and you know what a downtrend is, and you know that a trending market condition is when the market sees displacement. So displacement means sees movement. So the market is not just chopping sideways, rather the market is actually either trading higher or the market is trading lower. Either of them, but the market is seeing displacement. Now we're going to go into what that displacement entails in terms of institutional order flow. But first off, let's go back and conceptually define institutional order flow. So what is institutional order flow conceptually? As we can see indicated by the candlesticks and price. Institutional order flow is simply the provision of liquidity by the central banks to lower tier participants. So I'm going to type this out so it's really clear what I'm saying. So I'm going to make this in short. Institutional flow simply is IOF. Okay, I institutional, O order flow, F flow. Or sorry, I institutional, then O is order, and then F is flow. Alright, so let's define institutional order flow. Institutional order flow simply is the provision of liquidity by the central banks to lower tier participants. Okay, now those lower tier participants are large speculators and retail. Okay, those are who constitute lower tier participants in price. So institutional order flow is the provision of liquidity by the central banks to lower tier participants in price. Okay, now this is where we go into the market efficiency paradigm, where we have the delivery of liquidity from smart money, okay, who are liquidity providers. Smart money is the liquidity provider. So now when I say smart money, you know, obviously I'm talking about the central banks. They are liquidity providers. They provide liquidity to willing/unwilling liquidity. Price is delivered to engineer efficiency for smart money. Okay, the entire movement in price. I'm going to show you using a live price action example. And for those of you guys who are just watching the course, when you're done, I want you to go to that specific time in price, and you see me talk about all of those things before they happened. Okay, it was all documented. So when I'm doing the course, I'm using things I've talked about before they happened to explain that you can also anticipate these types of delivery in price before they even happen. Okay, so market efficiency paradigm simply is a provision of liquidity by the central banks to all the participants. Now, the reason why, something we've talked about in the first part of the course, the reason why the market is designed this way is because without this provision of liquidity by the central banks, there can be no transaction. There can be no exchange. Now, let's go back to the basic premise of what we're doing. What we do is called Forex. Forex is short for foreign exchange. Okay, you are exchanging one currency or one asset for another. Now the question is, who sets the price for that asset you're exchanging for? Okay, so if you wanted to buy shoes from Nike, right? If you wanted to purchase shoes from Nike, let's say you went to the store, for example, a new Jordan 1s came out, or let's say the new Jordan times Travis collab shoes came out, and let me look for one very specific. I don't want to use the Yeezys, something that's really popular that people can get behind. Okay, do people know about New Balances? Let's use New Balances. I'm a sneakerhead, by the way. I don't want to talk about obscure sneakers. I want to talk about more popular ones. So the New Balance 990s, they're the in thing right now. So let's say, for example, you wanted to purchase the New Balances. The New Balances 990s, you want to purchase that, and you went to the store. Now you go to the store and you see the price for the New Balance 990s. I think it's around $180. Okay, so you go to the store. Now it's $180 for the New Balance 990s. Who is setting the price? Who sets the price at $180? The company. Okay, the company sets the price because they create the product, and that's the same thing with the asset you're trading. Who sets the price for that asset you're speculating? The central banks, because they own the asset, since they provide the asset. Do you understand what I'm saying? Because without the Federal Reserve, you're not getting dollar. Without the Bank of England, you're not getting British pounds. Okay, they regulate and oversee that asset. So they are essentially the providers of that liquidity, or they are the storehouse of that liquidity. Now, they set the price and they provide the liquidity to all their participants. And that's why we call them smart money, because they are the ones who set the price algorithmically. It's not done manually. It's all done by an algo that is engineered for market efficiency. And that's why the market trades into levels of inefficient delivery. We talked about this on fair valuation. So different types of fair valuation, where the market goes into protective mode and creates inefficiencies in the price. The algo is designed to rebalance all of this inefficient price deliveries. Okay, so the algo is designed to facilitate transactions by seeking inefficiencies in delivery of price, or in delivery of liquidity, and seeking liquidity itself. Those are the two main core tenets of everything we do. And with that being said, everything you're going to learn from here forward in terms of institutional trading is going to revolve around these three main concepts. It's going to revolve around order blocks. It's going to revolve around stop runs. It's going to revolve around liquidity voids, aka inefficiencies. This is all you need as it relates to institutional trading. Okay, you need to know what liquidity are we trading up into. Okay, what institutional accumulation point, which is what an order block is, what institutional accumulation point are we expanding away from, or are we trading back up into? Okay, what liquidity pool are we seeing counterparty transactions going on for reversal? What inefficiencies in price can we spot in the market that price should be reaching up into or down into? These are the things that we concern ourselves with, and that's how we're different from retail, because retail believes the market moves based off individual participation and the collective actions by the herd in price, which is all false. And I went on Twitter and I said, there are some individuals who they use the alignment of the moon, which is, it's so crazy that people are trading that way. But there are individuals who use the alignment of the moon and the stars to trade, and they use that to find trades. And it's so funny, because imagine thinking the market is controlled by the phases of the moon or the phases of the stars, and how they align. Like, what bank is going to look at the stars to to find a trade? She's just like, I want to take a trade and I have to take a telescope out. That's how funny it is. But imagine I wanted to take a trade and I sat down and I said, I sat outside, my telescope on. Just, imagine I wanted to take a trade and I sat down outside and my laptop is beside me and there's a telescope on. And my girl comes down and says, "What are you doing, Jin?" And I'm like, I want to take a trade. I'm just watching to see if Orion aligns perfectly at the right constellation, and then I'll know if just trade opportunity on my end. Like, that's how insane it is. And I called the person out on this, and the person went absolutely insane. Like, the person got so mad at me and then actually blocked me. And I thought it was a joke. And there's a whole niche of traders who think the markets move based off the alignment of the moon to the sun and the earth and to the stars. And I'm like, what the absolute... I don't want to cuss in this video. Well, what the hell is that? Anyways. Alright, so we have delivery of provision of liquidity from smart money to willing/unwilling liquidity. Now, any entity who is not smart money can fall under willing or unwilling liquidity. Even you who's learning this, because you're still going to obviously take losses. Okay, there's going to be times where you are going to get it wrong, and just to clarify, that is fine. That's part of trading. You are not a robot. You're not an algo. You are trying your best as possible to mimic as close as possible what the algo is going to do. And you're going to get far better results than the average retail trader, but you're still going to have times where you get it wrong, and that's fine. So I want to teach you that that's fine if that happens, and you don't need to stress out, okay? Now, going back to what I was talking about, so we have the provision of liquidity by smart money, and they're providing to willing/unwilling liquidity, and this is how we get the market efficiency paradigm. Now, going back into our understanding of what institutional order flow is, institutional order flow simply is the provision of liquidity by the central banks, who are the source of a currency, to all the market participants. That's what institutional order flow is. So I'm going to use a chart of a pair that we actively speculated on last year, which is euro. Let's use purple stone. Okay, and why am I locking this on? All right, so after we saw a shift in delivery, I think from here we called euro going up into this, and also from here I think when price is somewhere around down here, we've been calling bullishness, but I don't want to go all the way back, so let's just do this. Okay, now what's institutional order flow? This volatility you're seeing in price, understanding the logic behind the volatility, okay, you're seeing in price. So now this is a drawn liquidity. Why is this a drawn liquidity? Look at the overall trend. What's the overall trend? Is the overall trend bearish or bullish? It is bullish. The overall trend is bullish. So even though we had a retracement all the way down into the bodies of the candle here, which is a rejection block, we saw an upside movement in price. Okay, so let's go out a little bit to a weekly time frame. And on the weekly time frame becomes clear what price is reaching for. So ever since we're down here, I've been calling for 1.5s on euro dollar, which is up here, and we're still a little bit far away from there, but I still believe, I'm still very confident that we're gonna get up into that 1.5s. Now, this is what I mean when I talk about the market is designed as a hedging program, okay, which is the market efficiency paradigm that you really need to understand. As we run lower, every time you see an up candle, the market makers are building in a long-term hedging program buy as we run lower. They know beforehand what you're driving price down to. All this beforehand. They know what you're driving price down to. Okay, you can see nothing behind here. They know already beforehand where price is going down into. Okay, the moment the market ran below the one big figure, which is when the power between euro and dollar flipped, which I was calling for a long time, everyone went absolutely bonkers. And then guess what happened? We had a shift in delivery, and then look at the reaction around every up candle. Okay, remember, if this is a mitigation block, what are the sensitive points of the mitigation block? I've taught you before. If this is a now bullish mitigation block, the sensitive points are what? High, high, close, and then the mean threshold. So let's try out. Okay. First off, let's identify the mean threshold of this candle. That's the mean threshold. We're gonna use a dashed line for that, and the the close of the candle, we're gonna use classic line, and you can see price trace on there, and look at the displacement. Obviously trace out into a BISI, and look at the protocol I taught you with BISIs. Okay, you want to see a complete fill of a buy sell balance source and efficiency, which is different from a fair value gap. Okay, so you can see this is a fair value gap here. You can see how price gives a complete closure versus a buy sell balance source and efficiency. Alright, so you can see pressure is down into the mitigation block. You see displacement. Guess what happens next? Again, the liquidity I called for all the way when price was down here was the liquidity up here, and that's where price was reaching for. Okay, but I want to see the way price is being delivered in the process. Okay, yeah, it's gonna make sense, I promise you. Again, let's look for the mean threshold because that's what's sensitive price. We're gonna make it a dashed line there, and you can see prior to running out this liquidity up here, look at this trade up down here, displacement. I'm not using this, I'm using the last up candle prior to run lower. That's what I'm using because that's where who's selling. That's the question. Who's selling into the up candle? The funds. The funds are selling into every up candle. That's who's selling into the up candle. Now, who is buying from the funds? Okay, so that will make sense. If the funds are selling into up candle, which makes our bullish order block. Oh, sorry, our bearish order block. If the funds are selling into the bullish candle prior to displacement lower, who is buying from them? Smart money, central banks. So what is happening? Their positions are on the water, but there's no problem because it's all a hedging program. You see, it is a hedging program. That's why the algo will reaccumulate around old areas of buys to allow the central banks mitigate positions because that's a hedging program, and then sponsor new positions for the funds who are trend following. And that's how you see the displacement here turn out the liquidity. Now look at this. Look at all of this. Again, this is a very recent price action. All of this is all recent price action. Now let me eliminate all of this. After we run the liquidity, now our new, and you're gonna notice before I use the mitigation block, I always wait for candle closure above the mitigation block to then utilize that for either buys or sells. Same thing here. Okay, after we close above, this can trace down there, sees displacement into liquidity. Now we'll close above these sub candles prior to displacement lower. Now watch this. Okay, take this from the body of the candle here. And that's the main threshold. And this is the high. Okay, so I want to use a numeral line, and for the main threshold, I'm going to use a dashed line. Okay, so let's get rid of all of this. So if we're seeing the expansion away from here, what do you think the market is going up into next? Where is the inefficiency? Again, remember, the market is designed to reprice into areas of inefficiency and or liquidity. Where is the next round liquidity after we're taking out this? Here, because it's inefficient price delivery. And then after that, if we trade through, where's the next round liquidity? Here. Now, do you see what I was calling for 1.15s when price is down here? That was why. That was what I was calling for 1.15s when price is down there. Alright, so let's go back and define this really. Now, remember these lines from this weekly mitigation block, because I'm going to go down to a lower time frame, and you're going to see the importance of those lines in price. Okay, so let's go down to a daily time frame. You can see what's going on here. Reaccumulation. Now watch this. We have equal lows down here. Okay, equal lows down there. All right, there's one. And then we have a rejection block down there. That is sell-side liquidity. Remember what I've taught you guys? In a predominantly bullish order flow, okay? In a predominantly bullish order flow, at an higher time frame discount. If you see a break on the low and price reject, that is a long-term sponsorship. That's one of the most powerful confirmations in price you can get. If price runs below a daily low at a daily, weekly, or monthly discount, when you are bullish with a very clear general liquidity, you know the direction for the next few weeks. That's all we've been doing all throughout. So go back, watch since the start of April. When April started, that was somewhere around here. Okay, go back and watch the recordings, and ever since we saw this candle, we're calling this as an objective. That's been the objective. We never called bearishness. We never called your dollar going lower. We've only been looking for higher prices because of this concept I'm teaching you guys. Alright, then I want to show you the delivery price. Now, all we're doing here was all accumulation. We're all accumulating at the main threshold of that of that weekly mitigation block. Then once we expand above, guess what we have in price? Last up candle, pressure on lower, that's a breaking block. Coupled with, what's this? That is the open of that weekly mitigation block. Why is price trading down there? Just a reason why price has traded down there. Because that's an item from point that's sensitive in price. Because sometime in the past, the central banks offered bearish order flow to the funds. So in the future, the algo will remember that price point. That's why I use very specific price points: high, open, and main threshold. Okay, at some point in the future, the algo will remember those levels and go down there to allow for new sponsorship. That's what's going on here. This is institutional order flow. Ladies and gentlemen, especially for those of you guys who are new, you have just been blessed, because I'm absolutely hyped up teaching this, and you can obviously see the excitement in my voice. I don't really think there's anything else to talk about on institutional order flow. You have absolutely been blessed with this. So what I want you to do is I want you to go back on all the commentaries, look for the example I'm using here on your chart. Okay, look at the day and then match that day with the time of the even commentary, and you hear me talk about all of these things. A year when I was discussing all of these things with the members on the even commentary. Okay, and we're talking about all the targets and the reasons why I should expand from there, and this is one of the concepts you just learned. Okay, that being said, you guys will have an awesome day, and I'll talk to you guys on the next lesson. Trade safe.